And one of the things you talk about is something John Farrow in his Gloom on the Way to Crete talks about, which is the drawdown. And you say, and particularly with China, drawdowns are normal. We should not be afraid of the Farrow drawdown.
Well, this drawdown we're seeing in China is absolutely business as usual for investing in Chinese equities. Every year you should expect a 20% annual correction. And every 3 years or so, you tend to have an over 30% correction. We had this in 2018, we had it in 2015 and 2011, and it's unrelated to the economic cycle. It's related to China's regulatory and reform campaigns, which tend to happen every once in a while. It takes time to rebuild confidence, but 3 months out, Chinese equities tend to be up 10%, and 6 months out, they tend to be up 20% during these moments.
Wait, hold on a second, Gabriela. Are you saying that it's a good time to go buy Chinese equities?
We fundamentally disagree with the thesis that China is now uninvestable. And that is not what we're speaking to our clients about or hearing from our institutional clients. It's really still a story about building a strategic allocation to Chinese onshore equities and onshore bonds. To me, that is one of the most important themes of the next decade, is the rise of China in portfolios. And it's really just about navigating these moments of volatility and thinking carefully about how to invest in China rather than going through an existential crisis every time we get these drawdowns. And in fact, it's what one of your guests said, the CEO of the Norwegian Sovereign Wealth Fund on Wednesday, not rethinking that long-term allocation to Chinese onshore equities.
Well, let's talk about how to invest in China. Let's go there, especially at a time when you've got so many cross currents. You've got the regulatory uncertainty around the shifting priorities of the executive leadership in China. You also have the slowdown that you're experiencing, as well as the COVID policies, which are much stricter than in places like the United States. How do you parse through all of this noise and figure out how to allocate at a time of such incredible uncertainty?
The noise is so high right now. The volume is extremely high. I think the trick is not to see each thing China says or does as an independent development, right? It's all a piece of a bigger puzzle. And what is that puzzle? It's all about this new phase of Chinese development. It's moving from a middle income into a high income country over the next 5-10 years. And it really wants to shift from the quantity to the quality of growth. And everything it's been doing over the past few months is aligned with that long-term plan. And what's quality? It's growth focused on innovation. What's innovation? It's not internet and social media. It's deep technology and renewable energy.
Yeah.
And it's quality also in the sense of the quality of life for workers, for customers, and for merchants.
Well, you talked about renewable energy there, Gabriela. China, of course, is trying to reach net carbon neutrality by 2060, and it wants to have peak carbon emissions by 2030. And I'm wondering how you just kind of think about that green transition when talking about an economy and a growth trajectory that has been powered by the industrial economy.
So an example of how China, we tend to think about China as being really difficult from an ESG perspective, and it is starting from further behind than other countries. But this is an example of China moving in the right direction here, thinking about the E. And China is extremely serious about this energy transition because it's focused on reducing pollution and improving the quality of life for its people. And this is going to involve a lot of carrots and sticks. Right, carrots in terms of developing its domestic renewable energy market, solar, wind. Carrots in terms of boosting the penetration of EV auto sales. China's already the largest EV market in the world, and this is just the beginning. And it involves sticks. China launched an emissions trading scheme this year to put a price on carbon and increase the cost for heavy industry. So it's all about that transition to higher quality growth and really navigating the winners and losers in that phase.
Well, and we've seen this borne out in commodities, specifically when you look at iron ore futures in Singapore. I mean, they're trying to pull back on steel production. A lot of that has to do with environmental concern, and that has shown up. But it also, the other side of that is the growth concerns that Lisa was alluding to. And I'm wondering how you think about PBoC policy here in a decelerating China.
One quick comment on the commodities. Yep, they're losers, kind of some of those heavy metals like iron ore and steel, but they're also winners, something like copper, for example, which is a huge input into renewable energy and electric vehicles. So a perfect example there. And in terms of policy, I think the way to see this is China, every time it has a growth slowdown, it's going to step on the accelerator less and less. So unlike, China 5 years ago. So it's very targeted easing here, maybe a reserve requirement cut or two, very targeted towards credit in high-end manufacturing and private industry. It is not that old China that lifts all boats.